Insurance is the number one industry that creates the most financially successful people. You could have had nothing, no money, but hard work, consistency, courage, and commitment, and you would be successful in this industry. We're really reaching the masses.
Yeah.
We have to reach the agents. We educate the industry more. In essence, we can educate you more. What makes us different is the way that we talk about life insurance that most people don't. Most people talk about life insurance as a need. I need life insurance, or when you die, you're going to have to start a GoFundMe.
And if you don't ask more questions as a viewer of who that agent is, has their strategy been stress tested? At the end of the day, they're just great marketers, not great agents.
What makes us different is we teach you why you may want life insurance. We teach you how life insurance could be used for your life, not just for your death. It's called life insurance, not death insurance. Once you understand the benefits, you're never going to look at life insurance the same way again.
Amen.
This is why mentorship is important. This is why being under the right leader is important. Getting with somebody like Matt, getting with somebody like myself is a slam dunk because we're teaching you these strategies. It's going to put you ahead of 90% of the industry. And if you're a consumer and you want to make sure that you get your policies the right way, why not go to the source of the people who know what they're talking about instead of hoping that you got it right?
Slam dunk, baby. Marvin, before we get into anything tactical, I want to give people a little context. You and I cross paths in the Bahamas at the Conference of Champions. Shout out to Moran and National Life Group. And we're surrounded by top producers of National Life Group, top agency builders, have their own independent marketing organizations, and people who have been in this business long enough to know what actually works and what breaks. This wasn't a hype event. It was in a rah-rah, not a public seminar, just real practitioners. Actually had to qualify to be there. So Marvin and I, for those of you watching, we ended up chopping it up late, cigars, real conversations.
Yep.
And what stood out to me between you and I wasn't that we just see the financial system similarly, but that we both care deeply enough about how people are taught money, not just what they're sold. And now we were both there for the same reason. This industry changed our lives, and with that comes responsibility, and especially right now when there's a lot of noise, a lot of opinions, and a lot of confusion about money. So for the folks that's watching this, today isn't about just promoting a product or crowning a philosophy. It's about you getting clarity over hype and helping people, helping you, our clients, our agents, our associates, potential clients, think better, not just buy faster. So with that being said, Marvin Mitchell, man, welcome to the Just Earn It podcast.
Man, I'm excited to be here, man. What you didn't mention is we did we were training also advisors all around the country.
And, everything than being on stage.
and we happened to be on a panel together. Right. So what I loved about that experience, not only did we educate together, that we learned from one another, but we got some dancing in too, man. It was a good time.
100%, man. 100%. And by the way, it's been a great relationship. You're an independent broker, so there's not one life insurance company that we hang our licenses with. Listen, whoever's got the best product and appropriate for our clients, that's who we go with. Before we jump into that, though, I want people to understand the context of you. Everybody's got a story of how they got started in the life insurance industry, because not everybody just wakes up and says, "I want to be a life insurance agent." So how did you get Marvin Mitchell to get started in insurance?
And that's a great question, Matt. It was actually a heartbreak that drove me into the financial industry. I grew up poor. I didn't have a lot of money. Most of my family was poor. In fact, all of my family was poor. In fact, nobody had a college education. Most of us didn't graduate from high school in my family. But one of the things I did have is I had a strong mom and I had a strong grandmother. Unfortunately, my dad wasn't around for the most of my life. But one of the things that my grandmother taught me is she was a faith person. I mean, she used to teach me not to let the circumstances of my life dictate the outcome. She used to teach me that I can do all things through Christ who strengthened me. And I carry that faith with me, man, every single day. And she believed in me, and she taught me to believe in myself. So as I mentioned, I was the first person in my family to graduate from college. And then I graduated college and I attended law school at Texas Southern. Now, while in law school, this is where everything shifted. my mom calls me and she said, I got bad news. Your grandmother
Mm,
is sick with cancer.
mm,
And as you may know, when someone gets sick, there's typically one or two people doing all of the work. And that was my mom. So I decided to move from Texas back to St. Louis, and I became my grandmother's durable power of attorney. You know, I was the only one with the college education. And keep in mind, I know absolutely nothing about
mm,
finances at
mm.
this time just because I got an education. They don't teach you that in school. So,
Right.
but one of the things that I remember is that she told her financial advisor that she was afraid that she would be a burden on her family.
Wow.
And that financial advisor, instead of making her safer, they made her more aggressive. So when the stock market crashed, she lost 50% of her money. She
Eesh.
had no long-term care insurance. So she spent the rest of her assets down on health expenses. And unfortunately, when she passed away, I found out she had no life insurance.
Wow.
So, you know, talking about one of her biggest fears being a burden on a family and the fact that she passed away, and I'm sure she didn't want it to be this way with absolutely no assets. And don't get me wrong, she didn't have an education, but she worked for the same company for 35 years. She had a retirement plan, and to see it just wiped away like that, it
Yeah.
really devastated me. So I decided to do a life mission to learn everything that I could about finances. So I began to read books, talk to mentors, do everything that I can. And I actually started my financial firm, believe it or not, in a Wall Street firm, Edward Jones.
Yes.
Um,
There you go.
yeah, I was at Edward Jones for about 5 years, and this is the end of the story here. But
One man broker office. Of course, in a backyard there in St. Louis.
yeah, yeah, and I know Dallas. They got several offices in
Yeah.
Dallas as well, but and all around the world. But this is my story on how I realized that the Wall Street advisors did not have what was in the best interest for the clients. Because I'm at this big firm, I was drinking the Kool-Aid, thought that I would never leave the firm, and then 5 years into my career, one of my first clients, she came to see me, and she said her name was Marla, and Marla said, "I cannot afford to lose this money. I just retired. I'm 63. I don't know what to do."
Yeah.
And I said, you know what? Don't worry about it, Marla. Hang in there. You're in it for the long haul. It's only a paper loss. You know, you learn this lingo, this jargon of the
Yeah.
financial
It'll
industry. And she
rebound.
looked me in the
It'll
eye,
rebound.
Matt.
It'll come back up.
She looked. Oh, what was that?
Yeah. Yeah. Hang on. It'll come back up.
Oh yeah. Hang up. Yeah, we tell them that. And she looked me in the eye and said, Marvin, I don't think you understand. She said, I cannot afford to lose any of this money. So I made the
Oh,
client safer, put her into some very, very safe investments, which I know Matt has and we all have. And guess what? I got reprimanded by the firm. Now, give me
wow.
the stock market crashed, and instead of losing 45%, this client lost 5%. So she was very happy. But the firm said I took her out of preferred funds, which means there are certain funds that pay these big Wall Street companies extra revenue to
Mm,
recommend their investments over others' investments.
mm.
And when I realized that, it really stuck with me. And I said, am I doing what's in the best interest for my clients? Or am I only doing what's in the best interest for the company? And that's when I decided that I had to leave the company. Now, people thought that I was crazy. I was making six figures. I was doing well at the age of 25, but I had to leave and go out on my own. And since that time, I've been able to really teach people simplicity, teach people safety, teach people security. Insurance is a big part of our portfolios, as well as low risk investments. And I will tell you, it's one of the best decisions that I can ever make. And the last thing I do every single day, man, we bake fresh baked cookies in my office. And the reason why, my grandmother, she loved to bake, and we just keep her memory alive. So that's what drives me every day to do what I do.
So if I visit you at your office, I'm going to walk and smell fresh baked cookies.
I'm in my office now, and I can smell the fresh baked cookies right now.
What hotel does? Is that the Radisson? Is that the Radisson hotel that does that? You walk in, you check in. What hotel?
DoubleTree, I think.
Doubletree. That's right.
Yeah, DoubleTree cookies. Those DoubleTree cookies are good too. I'm mad when they run out.
Yeah. Yep. Actually, I come back in every time I'm staying at a Doubletree. I come back. Hey, yeah, more cookies. My second day, I
Exactly.
want more cookies. But what a powerful story. What a powerful story. You know, that's why I often say that people get involved in financial services because of some pain. And
Yep.
along that journey, they realize what an honorable and respectable profession this is. And the sad part of what you just said there is what a lot of people that buy products and services from financial professionals, ourselves included,
Mm-hmm.
is that certain organizations don't operate on a fiduciary basis. They operate in their best interest first versus the interest of the clients first.
Absolutely.
And you and I being both independent, we have that capacity. We have the capacity to say, listen, we can pick and choose what company. Of course, these insurance companies, of course, they'll pay us different commissions at like 5%, 10%.
Mm-hmm.
But if you got enough volume, if you're more mature in your business and you elevate above that, you can find a lot. That's why I advocate for a lot of people. Get a lot of clients, man. So therefore, you're not worried about one client, two clients. You're trying to maximize commission because then you're not operating in the best position of the client. So I remember hearing, by the way, congratulations on all the marketing and PR that you're getting. I see a lot of, you're on the Earn Your Leisure podcast, you're on the Breakfast Club podcast. And brother, I just got to know you because a bunch of my guys started resharing your content. And but man, he looks like one of our guys, but he looks like one of our guys because we have a lot of multicultural in our firm.
Right.
But it's so good to know that even though we're not of the same firm, we're in parallel firms, still being able to operate and doing what's best for the client, even though we don't have any financial benefit of doing business together, but we have some parallel interests together. And I heard
you're just a good guy, Matt. So my spirit loves talking to people who I know are good people. You have a good heart, and I've been watching you for a while, and I know one of the things that caught my attention about you is you're not afraid to share your faith. You're not afraid to educate the people and give people the truth. You're very, very transparent. You don't sugarcoat it. You're very direct, and that's one of the things I will always respect about you.
Likewise, brother. Likewise, brother. And I love the way you share your stories. And one of them you talk about, you said the traditional money system benefits the government more than the individual. In plain English, how does a school to student loan to job to 401k pipeline actually work against people in the long term?
You got to understand, Matt. There's a book that's called "Outwitting the Devil."
Yeah.
I'm not sure if you read that. You read that book?
Sure.
It talks about drifters versus non-drifters. Okay. So drifters are people who just go through life and they just follow the system, hoping that the system has their best interests, right? The system tells you exactly what to do. As you mentioned, go to school, get an education, get student loans if you have to, keep paying for college tuition until you can't afford to do anything else. Then you get a job. Now you have to go buy a big house. You have to go buy a car. You have to support the kids. Now you have no choice but to be golden handcuffed to that particular job. And then you save in your 401k, which is a retirement plan of choice. If you save in your 401k and you max out that 401k, you're doing the best thing for yourself and your family. But what's not told is that if you max that out, you haven't paid taxes on that. That's tax deferred. You can't touch that money until you're 59 and a half without a penalty. So you're handcuffed into the 401k. And then when you finally decide to take the money out of the 401k, when you do retire, you don't know what the tax rates are going to be at that particular time. So if tax rates go up, guess what? It doesn't matter. They're not charging you taxes based on when you put the money in. They're charging you taxes based on when you take the money out. And you might say, well, okay, I don't need to touch the money. I don't need the income. It doesn't matter. The government has other plans. They control that money, not you. Remember, they're going to tell you, well, when you turn a certain age, we don't care what you say. We're going to force you to take that money out. And if you don't take it out, we're going to penalize you up to 50%. Plus, in addition to that, we're going to charge you taxes. So, by the way, good luck. So a person with $1 million portfolio, you think that's a lot of money in the 401k system. Well, in reality, if you take 5% of that, that's 50,000. When you take out taxes, you're probably only able to spend $3,000 a month. How does $3,000 a month sound for $1 million tax deferred account that you thought that you were in the best position for success?
Bam. Brilliant. And when you're looking at this, this traditional financial system, we got to go and think about this too as well. I share this all the time in my workshops. What's the biggest asset that we all buy? A house. Second biggest asset most people buy, car. Third biggest asset, most people, education. For most people, I'm not talking about the athletes and the academics, but for most people, do they buy these things cash or they borrow against it? They borrow.
Most people, borrow. They have to. Yeah.
And so now the three biggest things we all buy, and this, the borrower is servant to the lender.
Yep.
In Proverbs, it's in the Bible. And now we got to owe the bank for our mortgage. We got to owe the bank for our car. We got to owe the bank for our education. So now we're trapped. We're paying everything from our salary, from what you just talked about. If it wasn't for taxes, now we got to owe debt.
Yep.
And we never get out of that. So we got to find ways to stick it to the man and understand that the system is rigged against us.
Exactly.
In your opinion, Marvin, why do so many people not realize that traditional retirement plans often mean paying the biggest taxes at the worst possible time, which is in the years of retirement.
Well, see, most people don't realize that these retirement plans, such as the 401k, you think it's the standard. This hasn't been around that long. We're talking about late 70s, early 80s that these retirement plans really even came about. Before that, people really dumped their money into insurance plans, which it was tax deferred and tax free when they borrowed against it. So the government, they wanted to control the big portion of that money. So they created a huge marketing plan to make you think that this was the holy grail of retirement. It's just been talked about so long, they realized that most people will follow the crowd. And I want you to think of how interesting this is. We're following the crowd when we know that 77% of people run out of money before they die in retirement. So we're going to follow the same exact system that causes so many people to run out of money when, who was that, Albert Einstein, that said the definition of insanity is doing the exact same thing and expecting a different result. So Matt, you're a smart guy. If I came to you and if you came to me and said, "Hey, Marvin, man, let me just borrow $10,000." Now, if we don't know each other, and I said, "Matt, I don't know you, but here's $10,000." Now, what are two things you're going to want to know before you take a $10,000 loan from a stranger?
Yeah, I want to know what interest rate when you can pay it back.
What's the interest and when you have to pay it back? And what if I said, "Matt, I don't know. That's a great question. I don't know when you have to pay it back, and I don't know what the interest rate is, but one day I will determine what that interest rate will be. And on that day that I determine what the interest rate will be, I will charge you interest retroactively to the day that you gave me that loan at whatever I choose it to be at that time." And by the way, I don't know exactly when I want it back, but if you don't pay me back when I ask for it, I'm going to charge you a penalty of about 50%. Plus I'll charge you the taxes I'll charge you the interest that I don't know what it's going to be yet anyway. But go ahead and take this loan. You're going to think I'm crazy. But see, most people have already taken that loan and they don't realize it. You see, when you dump all of your money into these tax deferred, government sponsored plans and you delay them, you don't know what the interest rate, you don't know what the taxes are going to be. And you don't know what the required minimum distribution age will be when they force you to take it out. So who's in control, you or the government?
That's right. Control is independent taxpayers. They're overpaying
Absolutely.
it. They're overpaying it. Not only overpaying it, but now the government is poor stewards over the tax money they collect so they can fund quality leering centers in Minnesota.
Absolutely. It's crazy.
To get our taxpayers frauded by the way, it's many people. It's just not, the ethnic group I'm talking about in Minnesota, but everybody is scamming the American system. That's our tax dollars. And it's interesting you say that because I was interviewing a financial advisor for 30, 40 years. He and I worked on a reality show, believe it or not, in 2010 called The Invested Life.
Nice.
And when I interviewed him on podcast here a couple of years ago, I says, "Matt, I didn't realize this about life insurance, that life insurance can do these things." And then I brought in living benefits on top. But he says, "Matt, I honestly can tell you, I've been a Wall Street guy. I've been a large financial firm on Wall Street, financial guy talking to athletes here in Dallas. I've never heard of life insurance being able to do that. 40 years. 40 years. And
Wow.
And when people hear these type of things, it's completely opposite. And think about this: the traditional financial advisors, the traditional accountants, CPAs, attorneys who don't know how to really think for themselves. They look at things like, "Oh, life insurance, scam." You just talked about a whole iteration of things we're already being scammed for life insurance.
You got to think about it. I'm glad you said that, Matt, because that's pretty. I explain this to clients all the time. The version of Wall Street advisors, CPAs, attorneys that most of you all know, like, and trust is a byproduct of the same educational system that I just mentioned.
Yes.
You see, when I worked at Edward Jones, and I was there for 5 years, almost 6 years, and again, I was one of the top young advisors at Edward Jones. I never knew about any of this. Now, keep in mind, I'm around finances every day in my career. If I don't know that these things exist, imagine what the person who's not around finances don't know. And it's not being taught. Why? Because it doesn't benefit the company. And I tell people, Matt, it's hard to get a man to understand something that their wallet depends on them not understanding. Okay.
Wow. Powerful saying.
So If they taught their agents what we know now, the firm will take a loss of revenue because it pays way less commission the way that we offer our insurance products.
Yeah.
So they're not going to big scale teach all of their agents these things. They're going to teach you the traditional way that's going to pay them more commission, which I don't blame them from a profitability standpoint. But is it the right thing for the client? Is it the fiduciary responsibility the right thing for the client? I would say no.
I would agree too as well. If anybody was ever going to look up, be your own bank, most likely you run across Marvin Mitchell. They run across you. And when people hear that, though, when people watch this, it's a pretty killer tagline, right? Nelson Nash, become your own bank, infinite banking. Pamela Yellen, she took an iteration of that book too as well. But we've seen, you and I have been around long enough where we've seen many, many iterations of be your own bank, infinite banking, et cetera, BYOB. But when people hear iterations of that, infinite banking, be your own bank, it sounds almost too good to be true. So break it down. What does that phrase really mean? And just as important, what does it not mean?
I'm glad you said, what does it not mean? And I don't know. It's interesting because if you look me up, become your own bank, like you said, is one of the first places that pull me up. But I've stopped saying that. I don't even say become your own bank anymore because I think so many people get the wrong idea from becoming your own bank. So what a lot of people think that, and this might sound crazy to some of you, but to some of you, it may be what you're thinking. So let me just sort of redirect it. When you hear become your own bank, you might think if I put $500 into a policy and the death benefit is $300,000, that I have a bank worth $300,000, which means I can actually borrow $300,000 because I am my own bank. Now, as crazy as that sounds, I realize that is what the majority of people thought. I was doing a webinar one day and I talked about this. And someone said that to me, and I said, "Do you really think that the insurance companies are going to allow you to give them 500 and they're going to give you $300,000 while you're living just right away?" And they said, "That's not how it works." So I'm thinking I'm talking to one person that doesn't understand. Then all of a sudden, I get a wave of people in a room saying the exact same thing, and I said, "Oh my God."
Yeah.
Let me reverse and let me start from the beginning. So that is not what become your own bank means. What become your own bank means it's a different way of thinking about money. So instead of the traditional system that I mentioned earlier, it's thinking about a way to, number one, find money that you're losing unknowingly and unnecessarily so that you can recapture and become more efficient with your money so that you can actually build a cash value. Now, some of you might have the lump sum today. Some of you, it might be over time. But as you're building the cash value, that cash value continues to grow. So even when you borrow against it, notice I said borrow against it. You're not borrowing from yourself. Okay. Yeah. You're borrowing against your policy. It will continue to grow as if you never touched it. So hypothetically, if I built up my cash value to $100,000 and it's earning 5%, if I don't touch it 1 year later, it's worth $105,000. If I have $100,000 in my account earning 5%, but this time I borrowed $30,000, 1 year later, it's still worth $105,000. Why? Because I actually did not withdraw it. I didn't spend it. I became my own bank. I borrowed against it, which means I borrowed from the insurance company and they utilized my insurance policy as collateral. So it continued to grow. So think about real estate. If you do a home equity line of credit against real estate, the real estate asset is still continuing to grow.
Right.
You didn't cut up the real estate and spend it. You just borrowed against it. So you're doing the same thing with your insurance policy, but this time it's growing tax deferred, tax free, still compounding, and you can borrow against it later. Now, when you borrow against it, I still do want you to pay it back because when you pay it back, you give yourself greater opportunity to borrow more in the future. But here's the key. It's unstructured loan payments, which means that you don't technically have to pay it back. If you don't pay it back, it's subtracted from your death benefit when you die, plus interest. Okay. So again, I want you to pay it back, but there's nobody putting a repo in your house if you don't pay it back right away.
Yeah, the thought process there is like if I put $100 into my savings account and it's FDIC insured,
Hmm.
doesn't mean you borrow against the FDIC insurance.
Exactly. That's great. I love that point. That's good.
And so also, I love what you said there about borrowing against it, because unlike borrowing a cash out refinance on a property, yeah, you're borrowing against the home, but also you're cashing out the equity in there and you're
Mm,
reducing the equity inside your, because you're now monetizing it. Same thing too with borrowing against like a car loan or something like that. You're borrowing against the car, but you're also monetizing. You're losing the equity
right.
that's inside. You're eating it. Not with a life insurance policy though.
Yep.
You're not like, or borrowing from a 401k plan. You're actually having to liquidate the stock at the end of trading at that end of closing a bell at that day to get it out, but you're loaning against it. If you don't pay it back, you got to owe taxes on it and a pre-withdrawal 59.5 penalty if you're under 59.5 years old. But a life
So
insurance
Matt,
policy away from that.
yeah, what I love about what we do is we're not just teaching people about financial products. Okay.
Yeah.
I would be the first person to admit, um, life insurance is not an investment. Okay.
Mm.
It's not an
One more
investment.
time for the people in the back.
Okay, so you agree with that, okay?
Yeah.
Life insurance is not an investment. So if you're just buying a life insurance policy, even if you structure it the right way and you never touch it, you might as well just put your money into the stock market. It's
Yeah.
not an investment. Here's what makes it powerful. It helps you to leverage, which means that when you put it into the life insurance, and if you do it the way that we teach it, and you actually borrow against it, now your money is working for you 2 to 3 times off the same dollar. So that same investment that you would have done with your cash, by you putting it into your life insurance first and then borrowing against it, now you have your money growing in now your life insurance. Now you have your money growing in your asset. Now you can even use it to pay down debt while it's still growing. There's so many unique ways that you can use it, which is strategy over investment. Does that make sense? So you don't grow rich just off of savings. And you definitely don't grow rich off of just a simple investment, but you do grow rich when you understand the game and the strategy and how this actually works.
Absolutely, brother. Absolutely. And with that being said, the same follow-up question to that, or the same question, I have a follow-up to that, is
Mhm.
who's an appropriate client for infinite banking to be your own bank and who's not?
Yeah, great question. So the way I teach this and is that really there's three different types of people when it comes to money. Okay. Really quick, you have a debtor, a saver, and you also have a wealth creator. The debtor is someone who they go into debt and they spend their life attempting to get out of debt. Right? These are the people who say, if I can finally get out of debt, I'll be financially free. But guess what? There are homeless people on the street that have no debt. But that doesn't mean they're in a better financial situation than you because they have no assets. Okay. Then you have a saver. The saver is saving, saving, saving. And then they think they're in a much better position because they pay cash. They
Yeah.
save, 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 and then they pay cash. Well, they're in a much better position, but not much. Why? Because every time they pay cash, they stop the forward momentum of their money and they have to start over again and they lose the opportunity cost that they could have earned had they not used that cash. And what we do is we change the identity from someone that's a debtor to someone that's a saver to someone that's a wealth creator. Now, the wealth creator understands strategy. The wealth creator never stops the forward momentum of their money because as their money grows, they understand that they can borrow against that money as it continues to grow, and then they pay it back while their money is growing. They borrow against it and pay it back. So that's a long way of answering who is this not for? This is not for the person who is not willing to change their mindset when it comes to money. It's not for the person who believes that if I throw my money into this insurance policy, I'm automatically going to be rich. It's not what it means. It's not for the person who's still a debtor and are only using their life insurance and borrowing against it to get further and further into debt.
Yeah.
It's not for that particular person. It's also not for the person who's not willing to actually use the policy, right? It's almost like use it or lose it. If you just sit it there and you're not borrowing against it and using it, it's not going to work. Now, also, I tell people if you're expecting to put $50 into a policy and borrow 500 grand, this is not for you, right? It's for the person who understands that it takes time to build up. Yes, you do have liquidity, use, and control of your money, but it still takes time to build up. Some of you are saying, well, I don't want to wait any time to build it up. And these are the same people who are putting money into their 401k that they can't touch the money until they're 59 and a half. Okay.
Crazy.
So would you rather build it up where you have liquidity, use, and access and control of your money, or would you rather build it up where you don't? Okay. So who's it for? It's for the people who are willing to transform their thinking, and they're tired of the traditional financial system. They're also tired of agents who really just don't understand what these products do. And I'll tell you, unfortunately, 90% of agents, they don't even know how to properly structure a policy the right way. That's why when you get with somebody like
Isn't it
Matt or
crazy?
myself, the
Yeah.
benefit is 90% too high.
Yeah, no. It's crazy that just because you have an insurance license doesn't mean you're automatically trained in these strategies. You have
No.
to have some really in-depth, and you're part of a community.
Yeah.
I've been part of a community that's in-depth training, and it's ongoing. It's not
Yeah.
we just went to a course and say, okay, we're certified to do it infinite banking. No, it's an ongoing mentorship case study, refinement,
Absolutely.
development, because even the insurance companies don't know how to explain it. You call it
They
customer
don't.
service, they don't know what you're talking about.
Have you ever had someone, Matt? This is the funniest story. It happens to me all the time. Matt, man, I appreciate you, man. You changed my life. You talked to me about that life insurance, about how to properly structure my life insurance. And I went out and I got me a policy because of you. And you're like, man, that's great. Who'd you get a policy from? Did you go through our team? No, I knew somebody else and they did this. Okay, great. Well, what company? Hopefully they did it right.
It's all
State Farm.
Exactly.
And you're like, oh, God.
You're
I hate
not
to
in good
bring
hands,
this
bro.
to you.
Yeah.
So no, there's certain people and there are certain formulas that you have to understand, because in order for you to do this policy, you got to understand that just because you have a whole life policy, just because you have an index universal life policy, doesn't mean it's structured the way that we're talking about, right? Because you can buy a whole life or an index universal life that's structured for the highest amount of death benefit and the lowest amount of cash value. That's why you might have one, but you don't see your cash value growing much at all, right? And understand that if you're building this the right way, you want to structure it for the lowest amount of death benefit and the highest amount of cash value. Why? Because you're going to get benefits such as tax-deferred growth, such as the ability to borrow against it, such as protection on your principal, such as being able to utilize the collateral. You get all of these extra benefits on your particular policy, and it continues to grow as if you never touched it. But why don't agents talk about it? Because again, it can reduce their commission by up to 70%. Now, some just don't know, but even the ones who do know, do you think they want to reduce their commission by up to 70%? And do you think the companies that teach them want to reduce their revenue by 70%, right? So you have to make sure that you're with somebody who's ethical, somebody who really understands, somebody who's competent, somebody who really wants to help you, and they want to see you grow, and they're willing to give up even some of their own commissions to do
Yeah.
the right thing for the client.
Yeah, a couple of scenarios there that just come to mind is before balance sheet riders would come out, we used to blend the term.
Yep.
Like we would reduce the target premium and add term insurance policy to make sure they can throw more cash into the policy, which thereby for the agents that do or don't know this, which means you're actually reducing your commission.
Mhm.
And I thought to myself, I have no problem doing that because not only am I going to get this client, but I'm going to get 10 other clients, and I can fall asleep I can fall asleep well tonight.
Yep.
Knowing that I took care of someone's grandma, mom, dad, aunt, uncle in their best interest by taking my need, which is commission, and lowered it in the policy. Because I know I'm not going to make my money on one policy. I'm going to make my money over a volume of sales. That's my mentality looking at it. Next, the balance sheet riders started coming out,
Mhm.
and you can defer your commissions over a 5, 6, 7 year period, which hurts everybody looking for a big bump in that first year inside the insurance industry. But hey, we deferred it over 5, 6, 7 years to make sure you're constantly putting money into it, because we're incentivized now to make
Mhm.
sure we do your annual review.
Nice. Yeah,
So
change the game.
yeah,
Changes the game. I
and
will say this, that the insurance industry has changed so much for the positive over
yeah,
the past 20 to 30 years. I mean,
yep,
man, they've really taken a strong look. A lot of the companies anyway have taken a stronger look at what do the clients want. How do we balance that need for the agent and that need for the client, and how do we serve the client in the best way possible? So I'm really excited about what's the future horizons
yeah.
for this industry.
Because Marvin, to your point too as well, it's not only having a properly structured policy, but I would add on there too as well. Some of these insurance companies aren't designed for this strategy to begin
Right.
with. Like what you just mentioned, like the couple names that you just mentioned, they're not designed. Like they have no clue inside their corporate, inside their actuaries, how to create a policy designed for this type of planning. And then to your point, they go to establish it. They watch the video, watch the TikTok, whatever it can be. They got it with the wrong advisor. They ought to call Marvin. They ought to call his firm. They ought to make sure you're talking to somebody that knows this type of stuff. And
We're in a battle against miscommunication, miscommunication by companies who can't even offer what we can offer. Miscommunication off of companies who tell you there's a one-stop shop. There's only one way to do it. They tell you to only buy term and invest the difference, right?
I got that coming up here in a second.
Oh, good. I'll pause on it then.
Yeah, that's actually my next couple of questions here. Let me say on Infinite Banking, Whole Life, IUL, if you can summarize who's the most appropriate for a whole life policy, suitability, affordability, same thing too as well with IUL.
Yeah, so this is an overly simplified answer. So really, the real answer is it. We dive deep into your situation, and we're going to make the best recommendation for you. And sometimes it's a blend of both. Um, First thing I'll say is be careful of companies who say there's only one right way. So, for example, if I'm talking to a company and I say, "Well, do you offer whole life?" and they say yes, and I say, "Well, do you offer index universal life?" and they say no. My concern is, are they only recommending this product to me because that's the only thing that they can offer?
That's right.
Okay, same thing, index universal life. If that's all they can offer, 9 times out of 10, that's the only thing they can offer you, which means that you have to wonder if are they recommending the right thing. And I know both me, Matt, we don't do it that way. So that's the first thing I would say. The second thing that I would say is typically it's going to be between whole life or index universal life, again, properly structured. So I tell people the thing I like about whole life is that you're going to get a fixed rate of return. You know what you're getting every year. Let's say it's 4%, 5%. So if you're that type of person who you want to know exactly what you're getting every single year and you don't care that it's a lower rate of return, maybe whole life will be great. The other thing about whole life that's unique and is interesting is that typically you can borrow from it a lot quicker, sometimes within 30 days. You can borrow from that policy. So if I'm looking to utilize my policy quickly to borrow from it and go out and buy an asset to make my money work multiple times, I might go whole life. Now, the downside against whole life is, again, you're not making a huge return. So, for example, and when I say huge return, 4%, 5% maybe is your cap.
And no potential thereof. Anything better than that.
No potential outside of that. Now, an index universal life, what I love about an index universal life is number one, you get some pretty good returns. I mean, I'm averaging over 10% on my index universal life policy over the last few years. And the way it works is that they have what's called a cap. So let's say if your cap is 10, could be higher. Let's say your cap is 10. If the market makes 4, you can make 4. If the market S&P makes 8, you can make 8. If it makes 10, you can make 10. If it makes 12, you can still make up to 10. But if the market goes down, you don't lose. Okay. So I love the fact that you get higher upside potential, lower downside. Now, on the flip side, you won't be able to borrow as much from it as quickly. In fact, I tell people that you want to wait at least 13 months before you really truly consider borrowing from an index universal life. And if you think that's a long time, consider waiting until you're 59 and a half in your retirement plan, right? Now, with that being said, I like to set up my index universal life for long-term income as well, because I can grow it and make tax-free income for the rest of my life with these index universal life products. So a lot of times, if I'm younger, I'll most likely, if I don't need it right away, I'm going to go with an index universal life. Now, me personally, I have 8 policies total. I have 4 whole lives. I have 4 index universal lives, and you might have a blend as well. It really just depends on your situation. Do you want to add to that, Matt? I know you're obviously the expert on this strategy as well.
Bro, I got my OG policy. Do you remember Indianapolis Life?
I've heard of it. I've never sold it, but I've heard of it.
Yeah, this is my first one I got in 2003.
Wow.
2003 policy. These are my policies. For people that's inside the insurance industry, you can kind of tell who might be on your side,
Oh my God, nationwide.
Yeah, I got that. I got Forrester. Yeah. So in other words, make a long story short, I'm going to bore you with it, but I got a bunch of policies. And to your point too, Marvin, what about the policies or the agents? What I found too is I'd never buy from an agent that doesn't do this himself.
That's so good. And let me bring up one more point because I
Yeah.
get this sometimes.
Yeah.
And I know the listening audience, the viewing audience are probably thinking this. They're looking at the policies that you just held up
Yeah.
and they're telling themselves, oh wow, he mentioned Nationwide. I'm gonna go to Nationwide.
Oh, you're
Or
right.
he
Right.
mentioned
Yeah.
Indianapolis. I don't
Or,
even think they exist.
or
But
AIG.
or so
Yeah.
so so they're thinking it. And I will tell you, there's a reason why, number one, Matt has multiple different companies.
Right.
And I could probably tell you today, if Matt was choosing a policy for himself, he would not probably go back to that same company today. Why? Because those companies change over time. And we're also independent, which means that we have the companies, we can look at all of the different companies to make sure they fit your needs. So the answer isn't which company should I work with? The answer is what's the best agent that can help me to decipher all of these different companies to help you to pick the best one. So I wanted to make that clear first. Um, Let me tell you about the agents, right?
Yeah.
I hate to say it, but there are a lot of agents out there that are really screwing up the reputation of this industry. And I'll tell you, you mentioned to me that if you search become your own bank, I'm one of the first people that you see. But also, if I search insurance in general, Matt's one of the first names that I see. So they're seeing Matt, who's having his success, and he's having podcasts, and he has a team, and he's inspiring people, and they see the success that I've had, and they see that I'm inspiring people, and that masses of people are coming to me for help. And in this podcast generation that we live in right now, everybody wants to be the knowledge experts. So what happened to me, Matt, is I got a lot of people who are copycats. And don't get me wrong, I don't mind people going out and taking the message that I give and
Sure.
spreading it around. That's how we grow the industry. The problem is you're getting a lot of people who are not even licensed, or you're
Yeah.
getting people who are licensed and are not knowledgeable about this, and they're giving a lot of misinformation. And because of that misinformation, it's hurting the reputation of the industry. So I do want to give you all a warning that just because somebody says that they can do this doesn't mean they can, or it doesn't mean they're qualified, or it doesn't even mean they know what they're talking about. So this is why I always strongly recommend that you talk to somebody who knows what they're talking about. And I would tell you this, you will know them by their fruit. Okay, you will know them by their fruit. What team are they surrounded? For example, anyone on Matt's team, I know they're getting the right information, right? Anybody on my team, I know they're getting the right information. But if I don't know the source of where that information is coming from, I'm stepping back.
Yeah.
If I get a Primerica agent telling me something, number one, they only do term. I just want to make sure that's clear. But if I get a Primerica agent telling me buy term and invest the difference, but they only offer term and they're only allowed to offer one product, I'm going to run. So you have to make sure, number one, is that advisor captive or independent? What's the difference? A captive company can only offer one company. For example, if I work for MetLife, I can only offer MetLife. But if I'm independent, I can look at multiple different companies and I can help you choose between the best company. That's number one. Do they even understand how to borrow against a policy and structure it the right way? And the problem is that most people don't know,
Yeah.
right? So you have to be a little bit educated by people like Matt or myself to make sure that you know what you're looking for, right? So our job in this industry is not just educating you, is fighting misinformation that exists because of inexperienced people who are claiming to be experts and talking about things they don't know a lot about because they're looking for a money grab and they're not really looking to help the client.
Marvin, side note, I didn't prepare you for this. I'm just asking on the fly. You can deny me, you can shoot me down.
Sure.
What happens if we put together a conference, a training conference to train the industry? Like we put a conference out there, you know, together, people invest to come into our conference, and we'll pop open the hood. We'll show them everything we know about whole life. We'll show them everything we know about index universal, like to help the consumer, to help the public. Is that something potentially that we can possibly work together? And if for those of you out there, you're interested in doing that, put it in the comment section below if you are.
Man, I think that's a genius idea because if we're really reaching the masses, we have to reach the agents.
Yeah.
Because the agents are the ones who, don't get me wrong, these agents are not evil. right? I want to make sure I'm pointing it out. They're not intentionally attempting to give you misinformation. They're trying to feed their family,
Yeah.
right? They're attempting to, take what they might have, some clips that they heard, and they might be uneducated, but they were so inspired by it that they want to go out and they want to teach the same thing. So if we educate the industry more, in essence, we can educate you more. So hey, I think it's a great idea. I'm all for it.
Let's roll up our sleeves and figure it out offline. And for those of you out there that's watching this, the challenge I have with the social media, this podcast culture we have today, is sometimes the brand new agent that watches Marvin's videos might put it through a teleprompter or put it through AI
Mm-hmm.
and try to articulate it. And they're great at marketing it. They're great at TikToking it. They're great at creating eyeballs to it. And if you don't ask more questions as a viewer of who that agent is and who's training them, their experience, how long they've been doing it, has their strategy been stress tested? And they're just, at the end of the day, they're just great marketers, not great agents. So that's something to consider out there
That's
too.
great.
Since you kept nailing it there, Marvin, let's just go to it. Buy term and invested difference. It sounds logical.
Yes.
It sounds kind of logical. But if it worked the way that spreadsheets would say it should work, and everybody then would win. So why doesn't that happen in real life?
Because by turn, it's the same thing if we told you about the way that we structure policies, infinite banking, or if we teach you about, the way that we do our policies. And if you don't actually implement it or execute it, then you're not taking full advantage of it. Most of the people who are taught by term invested difference, they're not getting the type of education that we're given, number one, which means they're pretty much, it's just a thought in their mind. If I buy term and invested difference, I'll be okay. Now, if real life worked that way, great. But what happens in real life? People don't usually invest all of the difference, right? Things come up in your life, right? And then all of a sudden an emergency came and you're not investing that difference. So your account never grows like the projected buy term invested difference. The other problem with that only buy term and invested difference is that it doesn't take into consideration is what happens when those investments crash.
Yeah.
And the stock market loses 50% like it's done several times, 2008, 2001, 87, go back to all the way back to the Great Depression. I mean, it's normal for a big stock market crash to happen.
Yeah.
Right. The pandemic, even 2020. And another thing that doesn't take into consideration that's even more important, that is by term, right? Now, again, I'm not against term. In fact, I advise some of our clients that it's okay to get some term. You got a lot of debt earlier on and you want to, get some term earlier on. But the problem is with term is that only 97% of those policies are never executed. Only 3% of term policies are ever executed. People either cancel them early or they end up expiring. And then when they go out and they try to get more insurance, guess what? The premiums have went way, way up. They have nothing to show for it. There was no cash value built up in that term. And even worse, if they have a health situation, they can't even get the insurance that they want unless there's a convertible option, which not all of them have. So with that being said, what I love about the way that we do things, we're talking about permanent insurance. Now, I want to be very clear. Just because we say it's permanent insurance doesn't mean you have to permanently pay a premium.
I love
right?
it.
Permanent insurance means it just lasts throughout your life, but it can be properly structured. So, for example, if I'm a 60-year-old, I might not want to pay premiums for the next 20 or 30 years. I might want to set it up for a 7-year pay and then I'm done. You can set it up that way. It can be extremely flexible. But I like that because I never have to worry about what happens if I get sick, what happens if it expires. And guess what? If I do it the right way, I can still borrow against my policy and build assets the same way, but now I have my money working in multiple places.
That's one of my questions here coming up too. Pause on that thought for those of you watching this. Bookmark that. So then, in your opinion, Marvin, is the real failure of buy term and invested difference, is it about returns or is it by behavior?
Behavior. It's discipline, it's behavior, and also it's misinformation. I'm not going to say the person's name. It's so funny. I'm not going to say this person's name, but I just saw him. He was a special guest speaker at one of my conferences, so I was able to meet him recently.
Hey,
nice guy.
Tell me about him.
Very nice guy. Very entertaining. But one of the things that he says is buy term and invest the difference. You're going to earn 12%. Okay.
Woo!
Now, there's so much wrong with that statement, and it is based on a fallacy that the market will increase by 12% every year. We know that's untrue. Even if we look at the long-term returns of the stock market, it's not even 12%. But we know that there are times that the market goes up, there are times that the market goes down, and there are times that the market goes way down.
Yeah.
Most people are not earning 12% because, again, behavior. They don't even have the behavior to continuously earn the 12% because they're maneuvering their account in different ways. They're paying a lot of hidden fees, etc. So there's a lot of what ifs when it comes to that particular situation. And one of your mentors actually taught me this, Doug.
Doug Andrew, yeah, for sure.
Doug Andrews.
We just had a conference. He was at a conference a couple of weeks ago, for sure.
Oh yeah. One of the things he taught me is that, do I want to go for all of this uncertainty based on this and based on that, or do I want to go for a sure thing and certainty? And I'm going for certainty every single time. I want to know that my money is not going to take a big drop when the market goes down. I want to make sure that I'm insured, even if 25 years down the line, my health decreases, and I want to make sure I have that insurance. So again, I'm going for certainty, and I'm going for options, and I'm going for liquidity, and I'm going for utilizing my money when I want to, not when I'm told that I can.
And I think, and here's the irony between that statement, is because you're no matter what money is established in these products and services inside the insurance industry, but yet you're an entrepreneur. You're not certain, bro. You're not go by like, we don't know if our business day one, the 1 month one, 10, we don't know but we bet on us. But our serious money is bet on the safety and guarantees and predictability and certainty of the life insurance industry through IULs and annuities, etc. And
can I give you a real example, Matt, that happened to me? I remember, especially earlier on, I got my first policy when I was in my 20s, late 20s, and my company was growing. And I remember when I lost a couple of my key employees at the same time. It was devastating for me. And I didn't have the proper structure to maintain it. So my business actually began to, I was making crazy profits. So all of a sudden, it was going the opposite way. For the first time in my career, I was actually experiencing losses. And I remember a time came where I was like, am I going to be able to make my payroll? Now, keep in mind, I'm only 41 now. So at the time, I definitely was under the age 59 and a half. So I couldn't tap into my retirement plan without a 10% penalty and a lot of taxes. And I was searching for loans. I couldn't get a loan because a loan wanted to know, what is my income? Show me the last 3 months or 12 months of your bank statements. Well, that didn't look good. So they wouldn't give me any loan. I had no other choice. This is one of the first times that I realized that I had this powerful tool that I can actually tap into. And I called the company and I said, well, this is my last resort. Because keep in mind, I didn't know about this at the time. I said, this is my last resort. I said, is there any way that I can access this money that this says on my statement? It says that I have like 40 grand in my policy. Can I access that? And they said, absolutely.
Wow.
I said, really? I said, what do I have to do? They said, oh, it's under 50 grand. We can actually just do a phone verification.
Wow.
I said, really? They gave me $32,000 out of that cash value. It was to me in 2 days. I was able to pay my payroll, keep my business going, and live to fight another day. The next month, I had one of my best months ever with that breathing room that would not have existed if I was not able to borrow from my policy. So I'm a believer, not just what I teach people, but it saved me. It saved my business. And imagine if I didn't have that. Imagine if I had to liquidate my retirement plan, pay all of those taxes, pay all of my penalties, and still without even, the possibility that it would work. So, it's a big deal.
I love it, bro. In fact, it came to us too as well. We were hosting an event, and we went over budget because people at the event didn't stay at the venue. They went to go Airbnb, and of course, if you don't have the room block paid for, if you're taking up the venue event center, and you don't have people enough staying there, then they charge a host. Right. So this is what happened to us. So we had to pull money out of our IUL to pay the overcharge than we expect.
Wow, that's awesome.
Point. Yeah,
that flexibility is amazing.
I got to address this though as well. Since we're on buy, term, invest the difference, I'm going to go the flip side. They say the product that you and I are advocates of for the right client, the Index Universal Life, is a scam. And you see this Kyle Busch case right now, and they went on a TV interview. But when you strip away all the noise, what are people actually reacting to?
Well, you want me to tell you what scam means, Matt?
Please.
Still confused about money, right? Um, if if you're listening to the same people who gave you the faulty information that caused 77% of running out of money, then you're probably still confused about money. So the product in itself isn't the scam. The people that's teaching you the wrong information, that's the scam.
Yeah.
So, it's just like saying that you had a bad relationship, right? If you had a bad relationship before, is every single person that you ever get with in the future a bad person, a scam? Probably not. You had a bad relationship and you have to learn to say, okay, that was a bad situation. I got bad information, but that doesn't make the product a scam. They didn't understand the information. When you get someone who's ethical, when explain it to you, and I'll be the first one to tell you, it's not for everyone. Index universal life is not for everyone. Whole life is not for everyone. Even term life is not for everyone. But when you have someone that's ethical, that's breaking it down, that's showing you, that's teaching you that to have your best interest in heart, the only thing that's a scam if you don't listen to the guidance and listen to the mentorship and you end up in the same situation that you're in right now and you know that you need to do something different.
I'm glad you brought that up because I've actually got the document here, the lawsuit. Kyle Busch.
Tell me about it. Actually, I haven't heard too much about that lawsuit, so that's interesting.
Yeah, $8 million is what they're claiming they lost, and they're suing Pacific Life and they're suing the agent. And it's a 50-page document, and they got the emails between the agent, emails between the insurance companies. But you know what they don't have in here, brother?
What's that?
They don't actually have the illustration of the IUL design. Usually that's part of the lawsuit. It's nowhere in the Exhibit A, Exhibit B. They got everything else in here.
Yep.
And they go on the Dateline. Was it Dateline, or they're going to news to report on it, to be interviewed on it. And she says, "Listen, we want to plan for our kids. This money is supposed to be for our future." Da 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 da. But yet inside this, they're talking about it was a retirement plan or a retirement supplement plan. But why would you wrap IUL inside an irrevocable life insurance trust if you're trying to use it while you're alive?
Right. That makes no sense.
Correct.
It's bad information.
So it's not the product. I mean, Pacific's Life been around, for 150, 160 years? Strong.
And I'll also challenge you this. This is the most interesting. Unfortunately, if you're a company that's been around for over 100 years, especially in the society that we live in today, it's a litigious society, right? There are people who will attempt this. This is why we advocate protection. We advocate asset protection because there are people who will attempt to find a way to sue you. And I will challenge you on this. Any big company that exists, if you want, type in that company's name and type in the word lawsuit, and every last one of them have had lawsuits that they have to defend. Why do you think that every last big company, they have to hire attorneys on retainer because this is almost an yearly occurrence? It's a cost of doing business. The more successful that you are, the more people who are going to try to throw faulty lawsuits. And guess what? It's not even the people a lot of the times that are attempting to throw these faulty lawsuits. You know who it is?
Other agents.
It's attorneys who are actually promoting the big companies, and they're spreading all these big companies, and they say, "Hey, have you ever bought one of these policies? We got a lawsuit." And they put together these class action lawsuits because it's a money grab that these attorneys know that they're going to get a settlement most likely, and they're going to get 30 to 40%, sometimes even 50% of that lawsuit. So what happens is all of these people who you thought were getting a good deal because they were under this lawsuit, they're getting pennies, while the attorney is making millions and millions and millions of dollars because of a lawsuit that they brought about in a company who didn't want to pay billions of dollars to fight a faulty claim. So I do want to state that. So I'm not saying that there are not legit lawsuits, but I do want to tell you, I want to take you into the thoughts of the litigious society that we live in right now. So a lawsuit doesn't automatically make a company bad. The same way that just because they do insurance doesn't automatically make the company good. You have to do your due diligence and make sure it's right for you.
And to your point there too, Marvin, the conversations of the back and forth, the banter, the confusion, the lawsuits, the scam, the shots.
Mhm.
You know who really loses? It's the consumer, because they don't end up getting a
Consumer.
policy to begin with. They cancel the policy, don't get a
Yep.
term, they don't get a permanent, they'll never get life insurance.
And they pass away without life insurance, without the need. Matt, I don't know about you, but have you ever met anyone whose parents or loved one died that were super upset that they got a death benefit?
Of course, they said, how come we didn't get more?
Exactly. I've never met anybody who was mad or upset because their people were responsible and they did the right thing and they got a death benefit. But I've had a lot of families scrambling. I've had a lot of families infighting. I've had a lot of families who are looking through dresser drawers trying to see, is there a policy that we didn't know about? Because they understand that they're going to be burdened by the fact that they now have to do a GoFundMe to pay for the person's policy. I mean, funeral, right?
Hey,
So again, you got to
ATL or
think
car
about that.
wash.
Nobody has been mad.
Oh man, we're just nailing this, bro.
But one more thing I have to say. You know what makes us different, Matt? Because life insurance has, I do want to say the industry has got a bad reputation in the past, and I think it's improving a lot now. I think people are seeing insurance differently, but it used to have a very bad reputation. And what makes us different is the way that we talk about life insurance that most people don't. Most people talk about life insurance as a need, which means I need life insurance, or when you die, you're going to have to start a GoFundMe. You need life insurance because if you don't, your family is going to be this way and everything's going to be destroyed. And it's a lot of fear-based techniques. And I'm not saying any of those things are wrong, but a lot of people promote that. So when people saw life insurance agents, they would run the other way because I don't want anybody to make me feel guilty, or I don't want anybody to make me feel like less than or afraid because I don't have life insurance. And people would just buy the minimum policies just to say that they had life insurance so they wouldn't have to feel guilty. So the question would be is what's the least amount that I could put into this policy to say that I got it? And it usually happens when a loved one dies, they didn't have life insurance, and they
Yeah.
think to themselves, I better go out and I get some life insurance, and they get the least they can get. What makes us different is we teach you why you may want life insurance. Okay. We teach you how life insurance can be used for your life, not just for your death. It's called life insurance, not death insurance. How can you use it for your life, not just your death? And because of that, we actually have to turn people away. We get people who are saying, how much can I put in here? Can I put this much? Can I put, like, hold on, slow down. I know you want to do this, but let's not go too far. And we're talking people out of it. People rarely come to me and say, what's the least amount? They say, what's the most amount? Because again, they want it because they understand the benefits. And once you understand the benefits, you're never going to look at life insurance the same way again.
Amen. Amen. Um, Before I let you go, man, I got to bring this up because you talked about a play where you took $100,000 from your policy to buy a GameStop. I think you put a put option,
Yep.
and stock went down. You made 300 grand on the trade, or you've done this with real estate. Can you explain a little bit about that? Because that's game. I think
Yeah. So there are several ways. I'll explain that one first. There are several
yeah.
ways that I've used my policy as an example. And man, I wish I could share my screen, sure. But I will say this: there are several ways I've used my policy. One of the ways is what he's referring to as this option play. Now, I wouldn't necessarily try this at home. Now, this was my thought process when I did it. This was when GameStop, if you remember GameStop, people were driving the stock, like consumers were driving the stock through the roof. And in my mind, I said, there's no way that the big institutions and the people with all the money are going to keep letting this game play. So one day I said, well, I want to do a putt. I want to bet that it's going to go down, but I don't want to use my own money. So what I did was I borrowed from my insurance policy. It took 2 days to get there. Thank God, because the 2 days while I was waiting, it kept going through the roof, right? That's how lucky I would say it was a little bit of luck, right?
Yeah.
So I because I didn't actually know much about options this time. I didn't realize how heavy of a risk I was taking, but I put it inside of the put, right? Now, people would say that was stupid, but this is the reason why I thought this. I said, well, I had built up my policy to a couple $100,000 of cash value. My thought process was, even if I lose this gamble. It was kind of a gamble. I would still be okay because $100,000 inside the policy is still growing anyway, as if I never touched it, and I'm still earning interest on it. I said, but if I hit and I'm right and it does go down, I'm going to make $200,000 to $300,000, and I'll still be able to repay my policy back the $100,000. So, look, whatever you want to call it, it hit. I put my $100,000 back. All I had to pay was the taxes on the growth
Yeah.
of the from the account that I grew to $300,000. Now, have I tried that since? Absolutely. Absolutely not. Sorry. I'm going to take my winnings and it's going to be a story I'm going to tell my grandkids. I don't think
Jeez.
I'm ever going to do that again. Now, what I've also used it for is I bought a 76 unit apartment building. And that apartment building just sold. I've been telling this story forever, for 4 years, and it just sold. In fact, in December was the final sale of that, and I profited off of that property, $484,000 off the gain, and I was getting payments every single month for that 4 years. So I probably made about $560,000 off that entire policy. And the way I got it is I got a partner, two partners actually. I borrowed $140,000 because remember I paid the policy back. I borrowed $140,000 on my down payment for the property. My partners put in the rest. I was 34% owner, so when we sold it, 3.5 we bought it for. It sold for about 4.9. I got my share of the proceeds, which was $484,000. That was great.
I love it.
I had already since paid that policy back even before I got the profit. So that's another way I've used it. I've also used it to be a lender, right? The Bible says we are lenders and not borrowers. So I said, let me put that to use. So I know a lot of people were getting into real estate because I was part of a lot of real estate organizations and I did real estate myself. So what I did was I essentially became a private lender. Some people might call it a hard money lender, but I had really, really good rates. So my rate was only around 11 or 12%, while others' rates were like 16 to 18%. But what I did was I had them sign a contract for collateral where if they didn't pay me back my loan, then I could actually take possession of the house. Everybody paid me back. So I was actually making money off the people paying me back for the loan. And remember, because I borrowed it from the policy was still growing as if I never touched it. One more cool thing I did with my policy is I actually borrowed 20 grand from my policy for a down payment on a Lamborghini.
There you
Now you
go.
might be thinking, how is that an asset? That's a liability. Kid you not, real story. I'm from the show me state, Missouri, right?
Yep.
Now I'm not a flashy guy. In fact, I've sold that Lamborghini and I've sold my Rolls Royce since then. But let me tell you, it made me so much money because I had a mentorship. And as much as I promoted this mentorship, nobody ever got into it. And I knew I had the tools to teach the people, but nobody got into it. Literally the day that I posted that I had that Lamborghini, I had 27 people hit up my inbox and said, you still doing that mentorship? How can I join that mentorship? I
Uh,
made 200 grand off the mentorship because people saw that I had a Lamborghini. I could have paid off the Lamborghini with the people who were interested because I had the Lamborghini. It also drove down my marketing costs. So it was actually an asset to me, not a liability. So when you learn how to play the game, you can actually use your life insurance policy to actually turn any any liability into an asset. I bought a house in Atlanta and I still have this house. I got a mastermind coming up there in the next month. That house cost me $2 million in Atlanta, right? I don't live in Atlanta. So why would I buy that? Why would I borrow against my policy to buy that house? Because a lot of people were filming movies there. A lot of people were wanting to do their mentorships there. People were wanting to rent out the pool. It paid me $15,000 a month. I paid $11,000 for the mortgage. So instantly I was making at least a $4,000 a month profit from actually owning the property and not even living there and
yeah.
borrowing from my policy, and it was still continuing to grow. So again, there's so many ways that you can do this. There's something that I call the four-way play, and I'll end with this. The four-way play is very, very, very interesting. This is sort of a strategy that I utilize, right? I won't tell, well, maybe I will. So this is what I do. I fund my policy. I borrow against my policy. I also go out and I get business funding and I get credit, right?
Uh-huh.
Because I've learned how to take that credit and actually turn it into cash. And what I do is I utilize that cash to go out and get a down payment to buy an asset, like a property, right?
Mm-hmm.
The reason why I do that is now I'm making money on my life insurance policy. It's still growing as if I never touched it, tax free. I pay off the credit card right away. Why would I do that? Because I get the points, right? I can
Right.
travel, I can get a hotel, I can rent cars, I can do all of these, and I get these extra Amex benefits. And then I still got the property that I rented out that's still paying me income from renting it out. I use that income to pay down my loan, and I'm building equity on a house at the same time. And when the equity grows enough, you know what I do? I do the home equity line of credit, or I refinance, and I use that equity to go out and I buy another property. So I'm making money 4 times off the same dollar. I'm making money off the life insurance. I'm making money off the points that I'm getting. I'm making money off the first property. Now I'm making money off the second property. And then I'll structure it with the proper LLCs, the proper trust to protect my money along the way. And now I have a 4-way play if you really want to get spicy. So there are so many unique ways. This is why mentorship is important. This is why being under the right leader is important. This is why if you're an insurance agent and you're listening to this, you may only be living up to 15% of your capabilities in this industry, which is why getting with somebody like Matt, getting with somebody like myself is a slam dunk, because we're teaching you these strategies. It's going to put you ahead of 90% of the industry. And if you're a consumer and you want to make sure that you get your policies the right way, why not go to the source of the people who know what they're talking about instead of hoping that you got it right?
Slam dunk, baby. And you talk about the power of owning your life insurance. Can you say a little bit about what this industry has done for your life, what getting an insurance life has done for your career and business, and the mobility of the profession you just got involved in, and the impact you're making on other people? Because people see the products and the services, but they don't see the impact, the stewardship responsibility that's been invoked upon you.
Oh my God, it's made such a difference in my life. Well, first off, you have to understand that when you think of what industry has made the most millionaires, the first thing that comes to people's mind is actually real estate.
That's right.
And I understand why, but I refute that, because
You'd be right.
what I see and what I believe is most people didn't become rich with real estate. Most people became rich and then put it into real estate, right? So you got to understand, how did they get their wealth? Insurance is the number one industry that creates the most financially successful people. And the reason why it's so financially successful is because you could have had nothing. You could have had no leverage, no money, but hard work, consistency, courage, and commitment. And you will be successful in this industry if you're humble, if you're hungry, if you're honest, and if you're a happy person. Okay? You can be successful in this particular industry. Now, what it's done for me, not only do I have a staff that I'm able to support, one of the things that I love to do is give back to the community. So I started a scholarship fund, because when I was in high school, as a minority, my dad was in jail my entire life. My mom had me when she was the age of 15. Unfortunately, she was remarried, and it was an abusive relationship. So people like me are not usually successful. I grew up in a hood in St. Louis. There were gunshots all around me, different colors. You had to be careful not to wear the wrong color. So people like me were not supposed to be successful. So I barely got through school. I mean, I was a C average student, right? But I got through school. But I had a heart. I had a desire. I was street smart. I understood, right? And because of that, I took my college education and I ended up going to law school. And I ended up becoming a very successful and I didn't finish law school, but I went to law school, and I ended up becoming a very successful financial advisor. And it just made me think, how many youth are in the exact same situation that all they need is somebody to encourage them, to believe in them, and to show that they're worth it. So I actually started a scholarship fund for individuals just like that. And I've given out over $700,000 in scholarships. I would not be able to do this if it wasn't for this particular industry. I was able to build a team in the Philippines, and I was able to go to the Philippines and help, do give backs, build wells, and do a lot of different things in their community, get food and backpacks for those individuals. Not saying that I couldn't do that if I wasn't as successful, because you still can, but the impact of having the financial resources to do so. And more importantly, it's the freedom that I got from this industry. I mean, I can do this business from anywhere in the world. Just last month, again, I was in Hong Kong, I was in Macau, I was in Hawaii, I went to Atlanta, Dallas. I'm going all around. In the last 2 months, I've been to these places, and my business has continued to grow because I'm not tied down to a desk in this business, and I have freedom and control. So if you want that same freedom and control, there's no better industry, in my humble opinion.
I love it. I love it. Well, Marvin, listen, brother, you've been an amazing guest on the Just Earn It podcast. And that's the very last question I'm going to ask you. What does that phrase mean? Because especially in this world where people feel they deserve things, especially in this world where people are complaining about things, that's why we said just earn it. What does that phrase mean?
To me, It's my first time hearing that term. I'm glad you said it. Just earn it to me means you are not a victim. You're in more control than you think. You're the captain of your soul. You're the captain of your faith, which means you can create your own reality. And if you don't like your reality right now, it's because of the reality that you created in the past. The good news is that when you just earn it and take 100% responsibility, you can recreate whatever life you'd like to recreate right now. And you can go out knowing that first you can create it, then you can work hard and earn it.
For more with Marvin Mitchell, we got his links all in a video description here at the bottom. If you are interested in potentially, we haven't put this formally together yet. We're just bantering it here on this podcast. But if you'd like to potentially attend a workshop that Marvin and I are hosting to teach the insurance agents in our industry how to properly structure, how to properly select life insurance companies for your clients, put it in the comment section below too as well. We'd love to hear your feedback. If you're a client out there, you got some thoughts, ideas, your feedback, please put it in the comment section below. If you haven't done so yet, make sure you like that like button, you smash that subscribe button, and make sure you follow the Just Earn podcast. On behalf of Marvin Mitchell, I'm your money smart guy from Dallas, Texas. And by the way, Marvin's going to be here February 12th from Dallas, Texas. From Dallas,
yes,
Texas.
I will.
Guy. And until we meet again, continue to live smart, continue to love smart, and be money smart today. Go just earn it, baby. Let's go.